Wells Fargo declares the worst case scenario for the market would be an S&P 500 falling to 6,000 if in fact you do have a significant oil shock.
And if you own Nvidia, Microsoft, Alphabet, or Apple, what happens next in this war could hit you in ways most investors aren't even thinking about yet. There are three enormous reasons why this escalation could directly damage your artificial intelligence stocks.
The president told CNN within the last hour that the, quote, big wave is yet to come. So, we're watching all of that, and that in some respects will dictate how these various asset classes move.
The United States just launched a direct military strike against Iran. While most investors are staring at oil prices and defense stocks today, the real story, the one that hits closest to home for anyone holding artificial intelligence stocks, is the chain reaction this conflict sets off. Wells Fargo already put their worst case number on the table, the Standard & Poor's 500 index falling to 6,000, and the trigger they identified is an oil shock. Because if this conflict forces the closure of the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's entire oil supply flows every single day, you're looking at oil prices above $100 a barrel. And that one number is what unlocks the first reason your artificial intelligence stocks are in serious trouble.
10-year hit 392 yesterday. It's now at 404. So that's sort of kind of interesting to me too. Like, we're not seeing a massive panic.
The 10-year Treasury yield actually moved higher today. In a real panic, investors rush into government bonds and yields fall. That didn't happen. The bond market isn't convinced inflation is under control. It's sitting in an uncomfortable middle ground. And for artificial intelligence stocks, which need interest rates to fall to justify their valuations, that uncomfortable middle ground is not a safe place to be. And that takes us straight into the first reason. Artificial intelligence stocks are not normal stocks. They don't trade on what they earn today. They trade on what the market believes they'll earn years from now. Nvidia, Microsoft, Alphabet. These companies carry enormous premiums built entirely on one assumption: that growth stays strong, inflation stays low, and interest rates keep falling. That's the environment that makes a high valuation growth stock worth holding at any price. War destroys that environment. When oil spikes, inflation comes back. When inflation comes back, the Federal Reserve cannot cut interest rates. And when interest rates stay high, the math on every single artificial intelligence stock starts to break. Think of it this way. When money is cheap, investors are willing to pay a huge price today for profits that arrive 5 or 10 years from now. But when money gets expensive, that future profit is worth a lot less in today's terms. The stock price falls, not because the company got worse, but because the cost of waiting got higher. That's the first reason, and we saw this exact playbook destroy technology stocks in 2022. The moment inflation got out of control, artificial intelligence and technology stocks were the first to fall and the hardest hit.
It is Apple, it is Nvidia moving higher, it's Microsoft, it's Alphabet. So if there is ultimately an equity safe haven, those names once again prove themselves to be exactly that.
Now here's where it gets interesting, because today, on the same day this war escalated, Nvidia, Microsoft, Alphabet, and Apple all moved higher. The market called them safe havens. And on the surface, that sounds reassuring, but that bounce is exactly what makes the second reason so dangerous, because the stocks being bought as protection today are the same stocks most exposed if this conflict keeps getting worse. And the second reason has nothing to do with stock prices at all. It has to do with something physical, something that runs much deeper than what any screen can show you. While everyone watches numbers flicker on a trading terminal, there's a risk building inside this conflict that goes far beyond energy costs. The Middle East sits at the center of critical global supply chains for semiconductor manufacturing. The chips that power every single artificial intelligence system, the processors inside Nvidia's data centers, the hardware running Microsoft's cloud, the silicon behind every large language model being trained right now, all of it depends on specialty gases, rare materials, and precision components that flow through global trade routes running directly through this region. A prolonged military conflict doesn't just raise the price of oil, it creates uncertainty across the entire physical infrastructure that the artificial intelligence boom is built on, and uncertainty in supply chains means delays. Delays mean higher costs mean lower margins, and lower margins mean the earnings projections that justify today's stock prices start to look a lot less realistic. That's the second reason, and it's one almost nobody in mainstream financial media is connecting to artificial intelligence right now.
And the biggest wild card, I think, Iran is obviously trying to draw regional countries into the fray by attacking Qatar and United Arab Emirates. So far, they have been restrained in their responses.
Iran is already making moves to pull neighboring countries into this conflict. Qatar, the United Arab Emirates. So far, those countries have stayed calm. But you understand what happens the moment they don't. This stops being a US-Iran conflict, it becomes a full regional war, and a regional war in the Middle East is not something the artificial intelligence rally was ever priced for. Which brings us to the third reason. And this one was hiding in plain sight long before the war even started.
We have seen a growth scare.
Right.
The Atlanta Fed tracker was at 5.3%, and it's now at 3%. And it could even go a little bit lower because January was really crummy for retail sales and auto sales.
The Atlanta Federal Reserve's growth tracker has dropped from 5.3% all the way down to 3%, and it could fall even further. Retail sales in January were weak. Auto sales were weak. The economy was already showing cracks before this war started, and that matters enormously for artificial intelligence stocks. Because the entire bull case for this sector rests on one critical assumption, that corporations keep spending confidently on artificial intelligence infrastructure, data centers, cloud computing, semiconductor chips. All of it requires companies to believe the economy is strong enough to justify those massive investments. A growth scare changes that instantly. Companies get cautious, budgets get reviewed, and the first thing that gets questioned is the most expensive new line item on any balance sheet, which right now, for most major corporations, is artificial intelligence. If spending slows, revenue growth slows. And if revenue growth slows, today's valuations become very hard to defend. That's the third reason. And the dangerous part is that this one doesn't need the war to get worse. It's already in motion.
I don't think you have the all clear here. I think you just get the pass on you don't break down because of a geopolitical shock.
This is the honest read from Wall Street today. Not panic, but not relief either. The market didn't collapse, and that's something. But not collapsing is a very different thing from being safe. And the analysts being straight with you are all saying the same thing. You do not have the all clear, not yet.
Barclays today suggests it's simply too early to buy any dip until you get a sense of how long this really could last.
Barclays put it bluntly, too early to buy the dip. And that matters because the entire playbook for artificial intelligence stocks over the last 2 years has been built on one instinct. Buy every dip, hold through every headline, trust the long-term story. That instinct has been right. Every dip recovered fast. But Barclays is drawing a line here. Before you act, wait and see how long this actually lasts. Because 4 to 5 weeks of military operations is not a weekend headline. That's a sustained campaign. And sustained campaigns create the kind of uncertainty that reprices entire sectors. So here's where all three reasons land together. The first, if oil breaks above $100 a barrel, inflation returns and artificial intelligence valuations come under serious pressure. The second, if this becomes a regional conflict, the supply chains powering the entire artificial intelligence boom face real physical disruption. The third, the economy was already slowing before any of this started, and a growth scare could freeze the corporate spending that every artificial intelligence company depends on to justify its stock price.